When you think about a legacy whiskey brand, you naturally picture these massive charred oak barrels silently aging in some dark, dusty rickhouse down in Tennessee or
Oh,
Kentucky.
absolutely. It's this picture of perfect, unchanging patience.
Right. You just put the raw liquid in, you wait a decade or so, and eventually you pull it out. You can almost smell the wood and the history.
And it implies total stability. The recipe hasn't changed in generations. The process is practically sacred. And as consumers, we just sort of expect the business side to reflect that steady, slow-moving reality. We assume it's a calm operation.
It's comforting, really. But then, you step out of that rick house and crack open the actual financial ledger for a company like that in the modern economy. And suddenly, that image of slow, unchanging patience, it just completely shatters.
It really does.
You realize that to keep that old school image alive on the shelf for you and me, the business behind it has to be moving at this frantic, almost ruthless pace.
Yeah, it is the absolute definition of corporate agility hidden behind a vintage label. The contrast between the slow-aged product in the bottle and the high-speed process of, well, just keeping the company afloat is incredibly stark.
Welcome to today's deep dive. We are thrilled to have you with us. Today, we're looking at the Q4 and full fiscal year 2026 earnings report from Brown Forman. This report was literally just published on June 4, 2026.
And for anyone who might not recognize the corporate name instantly, you definitely know their bottles. Brown Forman is the 155-year-old global spirits giant behind Jack Daniel's, Woodford Reserve, Herradura Tequila, and, a massive portfolio of other
A
brands.
huge portfolio.
Right. And our source material today consists of their official corporate financial results, their press releases, and the really deep-in-the-weeds earnings presentation they delivered to investors.
And our mission today isn't just to read off a spreadsheet for you. I mean, nobody wants to listen to an audio accounting textbook.
Definitely not.
We are going to extract the most fascinating insights from this stack of documents to show exactly how a legacy consumer brand navigates a wildly unpredictable global economy, shifting consumer tastes, and honestly, some pretty brutal corporate restructuring.
It's a lot to dig into.
It is. Okay, let's unpack this because the very first thing that jumps out from these high-level financial metrics is a massive contradiction. It is a total financial paradox.
It really is. When you look at the top-line numbers for fiscal year 2026, the initial impression is undeniably negative. I mean, reported net sales decreased by 1% down to $3.9 billion.
Ouch.
Yeah, and their operating income dropped by 10% to $1.0 billion. And their diluted earnings per share, which basically means the actual profit tied to each individual slice of the company's stock, that fell by 17% down to $1.53.
Right, so if you stop reading there, you think, wow, rough year for the whiskey business. People are drinking less, the company is shrinking, panic in the boardroom.
There you go.
But then you keep reading, and the math seemingly stops making sense. Despite sales going down and profits taking a hit, their gross margin actually expanded.
It did.
It went up by 1.6%, or what they call 160 basis points to hit 60.5%. And here is the real kicker. Their free cash flow skyrocketed by $462 million to reach $893 million.
That's a huge jump.
Massive. Their overall cash flow from operations actually hit $1 billion. And because they had all this cash, they returned a massive $827 million to stockholders. That's $427 million in regular quarterly dividends and exactly $400 million through a share repurchase program.
What's fascinating here is how a company can shrink on the surface but become significantly more cash-rich underneath. It challenges our basic assumptions about how business growth works. We usually think, more sales equals more cash.
I mean, think about this like a personal finance paradox. It's like looking at your bank account, realizing you took a pay cut at work this year, but somehow you have double the cash to spend on weekends, and you're just handing out bonuses to your family.
That's a great way to put it.
How exactly does a company shrinking in overall sales generate nearly $1 billion in free cash flow?
It comes down to what happens behind the curtain, right? The physical mechanics of the business that consumers never see. First, we have to look at disciplined working capital management.
Okay, what does that actually mean for a distillery?
Well, in the whiskey business, your capital is literally locked inside wooden barrels for years. When sales are slightly down or flat, a smart company doesn't just keep firing up the stills and producing at the same frantic rate. They tighten up their inventory.
Oh, I see.
Yeah, they manage their accounts payable and receivable much more aggressively. They keep the cash in the house longer, rather than tying it up in physical liquid sitting in a warehouse.
So they are essentially hitting the brakes on production to match the slowdown, which frees up the cash they would have spent on green and new barrels and all that.
You're spot on about the warehouse.
Yeah.
And they paired that by pulling the plug on big physical projects.
Hmm.
We saw lower capital expenditures across the board this year. They simply spent less money on expensive new facilities.
Makes sense.
But the biggest factor driving that gross margin expansion, that 1.6% jump to 60.5%, is the positive effect of strategic divestitures. They sold off less profitable parts of the business. So while the total revenue pie is slightly smaller, the pieces of the pie they kept are far more profitable.
The CEO called this a robust capital allocation strategy, which honestly feels like corporate speak for we figured out how to squeeze a lot more juice out of a slightly smaller lemon.
That is the perfect translation. They are extracting more cash out of fewer sales. And by using $400 million of that cash to buy back their own stock, they are signaling to the market that even in a downturn, they are financially bulletproof.
Right. But, the explosive growth of cash is great for Wall Street, but what does this mean for the actual drinks? To understand why those top-line sales are dipping in the first place, we have to move from the corporate balance sheet over to the actual bar cart.
We do.
We need to look inside the bottle to see what consumers are and aren't drinking right now.
And the product mix tells a very clear story about shifting consumer palates. Overall, whiskey net sales are up 3%, or 1% if we look at it organically. But the driver of that growth is not what you might expect.
No, this is the part that completely blew my mind. The
Mhm.
core product, the iconic Jack Daniel's Tennessee whiskey, like the classic old number 7 in the square bottle that is practically synonymous with American whiskey, is actually declining in sales.
It is.
The growth in the whiskey portfolio is being driven by the launch of a new flavored offshoot called Jack Daniel's Tennessee Blackberry, as well as the continued growth of their premium bourbon Woodford Reserve.
And we're seeing pressure in other traditional categories, too. The tequila portfolio, which includes major legacy brands like Herradura and El Jimador, is down 4%.
Yeah.
Herradura alone declined 9%, heavily impacted by lower volumes in the United States.
Wow. But then you have the absolute breakout star of the entire report. If you've walked down a liquor aisle at your local grocery store recently, you've probably noticed this yourself.
Oh, everywhere.
The shelves are suddenly just a sea of aluminum cans. The ready-to-drink category, or RTDs, jumped 11% for the company. And specifically, a brand called New Mix, which is a tequila-based ready-to-drink cocktail in a can, saw a massive 41% sales explosion.
41% growth for a single brand in a mature 155-year-old company is staggering. That growth is being fueled by huge market share gains in Mexico, where the RTD category is accelerating rapidly, and by the product's recent launch in the United States.
I have to challenge the strategy for a second, though. Is this a crisis of the classics? Because to me, it feels like the iconic old number 7 is losing its edge, and instead of fixing the core appeal of their flagship whiskey, they're just slapping a blackberry label on a bottle or pivoting to canned cocktails to mask the decline.
It's a fair question.
Are they mortgaging their legacy for a quick sugar rush?
If we connect this to the bigger picture, it's not really a crisis, but a strategic pivot. Slapping a BlackBerry label on a Jack Daniel's bottle absolutely threatens to alienate the purists who built the brand's rugged image. But mathematically, they have no choice but to chase where the volume is going.
Because of demographics.
Exactly. We are seeing a profound generational shift in how alcohol is consumed.
Meaning younger drinkers just aren't sitting around sipping neat whiskey by a fireplace.
Not in the same numbers, no.
Yeah.
Younger consumers are less loyal to traditional neat spirits and much more interested in variety, ease of use, and flavor experimentation.
More convenience.
Right. If Brown Forman stubbornly refused to innovate because they wanted to protect the absolute purity of old number 7, their overall numbers would be looking incredibly grim right now. They're using innovation to bridge the gap while the traditional brown spirits face these heavy macroeconomic headwinds.
Okay, but the explosive 41% growth of those canned cocktails isn't happening everywhere uniformly, which exposes a massive geographical divide in their business. Knowing that an RTD boom in Mexico is propping up the numbers naturally leads us to look at the global map.
The geography is really revealing.
The geographic data in this report reviews how macroeconomics are totally reshaping trade for American spirits.
The global landscape is completely uneven right now. Let's start with their home turf. The U.S. market declined by 7% on a reported basis, though it was flat organically. Developed international markets, places like Germany and the United Kingdom, were also completely flat.
And in the middle of all this flatline data across the developed world, there is a highly specific, almost bizarre disruption mentioned in the report. Sales of Jack Daniel's ready-to-drink products took a hit because American-made beverage alcohol has been largely absent from retail shelves across most provinces in Canada.
Yeah, that was a surprising detail. When you think about global trade, we often picture massive container ships stuck in canals.
Wow.
But here, a major market right next door simply has bare shelves for their product.
Just empty shelves.
Right. It shows how vulnerable global supply chains and regional trade relationships can be. When Canada suddenly drops off the map, it creates a noticeable, multi-million-dollar dent in the earnings of a global giant.
Okay, here's where it gets really interesting. So the US is down, Europe is flat, and Canada literally has empty shelves. I'm looking at this thinking it's a bloodbath, but then you see the counterweight.
The emerging markets.
Yes, the growth engine has completely shifted to emerging markets. They jumped 14%. And the surge is being led by places like Turkey, the United Arab Emirates, and Brazil. Plus, the travel retail channel, like the duty-free shops at international airports, rose 6% because global passenger traffic is booming again.
Grouping those statistics tells a fascinating story about modern corporate survival. It's like a teeter-totter. When the traditional developed markets hit a wall, you need the emerging markets and global travel to pull the weight and keep the whole structure balanced.
But is that a sustainable balance? I mean, think about the irony here. The most famous American whiskey in the world is struggling at home, missing in Canada, and leaning on Turkey and the UAE just to stay afloat. It feels like emerging markets are the only life raft they have left.
Well, that assumes the decline in the U.S. is purely because Americans stopped wanting to buy the product, which isn't the full picture.
It's not.
No, a huge chunk of that 7% U.S. decline is tied to intentional, engineered business moves. For example, Brown Forman intentionally ended a distribution relationship with Korbel champagne sellers,
Yeah.
and they walked away from transition service revenue tied to their sale of Sonoma-Cutrer wines.
Oh, wow. So they essentially chose to take a hit on revenue because those specific streams just didn't fit the long-term plan anymore.
Precisely. Furthermore, they enacted higher net pricing across the portfolio in the U.S. due to changes in their distributor relationships.
And higher prices mean fewer bottles sold.
Exactly. Whenever a brand raises prices on the shelf, you almost always see a temporary dip in the volume of bottles sold. So the U.S. decline is partly by design. Emerging markets aren't just a desperate life raft, they are a proactive growth engine, balancing out a calculated restructuring in the West.
That perfectly transitions us to the most brutal part of this report. Navigating these geographic shifts and changing consumer tastes requires a leaner, faster corporate structure. I want to look at the painful but necessary strategic cuts Brown Forman made to survive what their CEO called a challenging cost cycle.
It was a significant shift.
It's like taking a massive, heavy wooden ship and throwing the cannons overboard so you can outrun a storm. You lose some firepower, but you stay afloat.
And they threw a lot overboard. The company executed a major strategic restructuring initiative that was announced back in January 2025. In fiscal year 2026 alone, they incurred $19 million in charges related to this. The human cost was a 12% reduction in their global workforce.
12% is a massive cut for a company that prides itself on heritage. And it wasn't just people. They sold off physical pieces of their history. They completed the sale of the Brown Forman cooperage facility.
For a whiskey company, selling the cooperage is a deeply symbolic, fundamental shift. A cooperage is where the wooden barrels are made.
Right.
Historically, Brown Forman was one of the only major spirits companies to vertically integrate this, meaning they made their own barrels to maintain absolute quality control over the wood that flavors their whiskey.
So by selling the facility where they literally make the barrels that give Jack Daniel's its flavor, they are pivoting hard away from traditional vertical integration toward modern, outsourced financial efficiency.
That is the exact trade-off.
Yeah.
We also see this reflected in their non-branded and bulk sales, like selling off used barrels to other distilleries, which plummeted 68%.
Wow.
Yeah, and they also finalized the divestitures of Finlandia vodka and Sonoma-Cutrer wines. They are shedding brands and physical assets that don't fit a hyper-focused core of whiskey and premium tequila.
Okay, so I understand selling off the cooperage and the vodka to get leaner. But this brings me to a part of the balance sheet in this restructuring that I really need to reason through with you because at first glance, the math feels totally backwards.
Let's hear it.
In recent years, Brown Forman acquired two premium brands, Gin Mare, a Mediterranean gin, and Diplomatico, a super premium rum. In this very earnings report, they boast about how these two brands are experiencing strong double-digit growth. I mean, Gin Mare volumes are up 36% organically. Diplomatico is up 17%.
Incredible operational numbers.
Right. But then you look at the expense column, and the company took massive impairment charges on them. They wrote down the value of Gin Mare by $45 million and Diplomatico by $87 million. That's a combined $132 million hit to their operating income.
It looks entirely contradictory on paper.
So wait, if the liquid is flying off the shelves with 36% growth, the only reason you take a $132 million hit on the books is if the underlying math of the acquisition changed.
Yes, exactly.
Is this because interest rates and the cost of borrowing money have spiked since they bought it? Like buying a luxury sports car, bragging about how fast it goes, but having to admit you massively overpaid because the market shifted?
That is a phenomenal way to look at it, and it perfectly captures the macroeconomic reality. Impairment charges are what we call non-cash accounting adjustments. They didn't actually write a check for $132 million this year.
So it's a paper loss.
A mandatory paper loss. When you buy a brand, you record its value on your balance sheet based on a set of assumptions, expected future cash flows, global interest rates, and the cost of capital. Gin Mare and Diplomatico are performing incredibly well operationally. As you noted, the bottles are selling.
Right, 36% growth is huge.
Exactly. But since they acquired those brands, global interest rates shifted, inflation has remained incredibly sticky, and the cost of doing business is just higher.
So when the accounting department runs the required annual tests to see what those brand assets are worth today in this new, tougher economic environment, the mathematical present value is lower than they paid for it during a boom time.
It perfectly illustrates the market volatility the CEO warned investors about. You can have a massive hit product, but a tough global economy still forces you to take a hit on the balance sheet. They have to adjust their books to reflect the current reality of the market, regardless of how well the sales team is doing.
Okay, so let's bring this all together for everyone listening. What we are looking at is a 155-year-old giant that is simultaneously leaning into clever, rapid innovation like blackberry-flavored whiskey and the exploding New Mix canned cocktails while executing incredibly aggressive corporate restructuring.
It's a massive balancing act.
It really is. They are throwing cannons off the ship, shedding a 12% chunk of their workforce, selling off their historic barrel-making cooperage, and taking mandatory paper losses on premium brands. And the result of all this pushing and pulling is that they are generating massive billion-dollar cash flow, even while their core traditional products and their primary developed markets are basically stagnating.
It is a phenomenal case study in modern corporate survival. They aren't sitting around waiting for the golden days of the market to come back to them. They are actively resizing and reshaping the physical and financial structure of the company to fit the market that actually exists today.
And if you are listening to this, you might be wondering why you should care about the gross margins or working capital of a whiskey company. But the relevance here spans across almost any industry.
Absolutely.
Whether you are an investor trying to monitor the fragility of global supply chains like we saw with the empty shelves in Canada, or you are a business leader trying to understand corporate agility, and when it's time to sell off a legacy asset like a 100-year-old cooperage, there's a lesson here.
For sure.
Even if you are just someone standing in the liquor aisle deciding what to buy for a weekend barbecue, this deep dive proves that legacy companies cannot survive on nostalgia. They must constantly, and sometimes painfully, reinvent themselves to stay relevant to you.
And they fully expect that need for painful reinvention to continue. Looking ahead to their fiscal year 2027 outlook, Brown Forman is projecting that the macroeconomic pressures and geopolitical instability will persist.
The storm isn't over.
No, it's not. They are forecasting organic net sales to be essentially flat, and they actually expect organic operating income to decline by another 3% to 5%. The challenging cost cycle is definitely not over.
So as we wrap up, I want to leave you with a final thought to mull over. We started this deep dive talking about the image of perfect patience, the giant oak barrels aging in the dark for a decade. But we've seen today that the real growth engine for this legacy company isn't the old school neat whiskey. It's a 41% explosion in a ready-to-drink canned tequila.
That's wild to think about.
As consumer habits shift increasingly toward hyper-convenience and instant gratification, will the future of legacy beverage brands be defined by the quality and tradition of the liquid aging slowly in a barrel? Or will it simply be defined by the convenience of the aluminum can it comes in?
It's a question every legacy brand in every industry is going to have to answer in the next decade.
Thanks for joining us for this deep dive. We'll catch you next time.